I've been investing for over 40 years, and in that time I've made multiple millions. But if all of that disappeared tomorrow, and I had to start again in 2026 with no investments, a normal salary, and just my phone, what would I actually do? I get asked this question constantly. So today I'm going to walk you through the exact step-by-step process I'd follow right now, in this economy, with today's tools, as a complete beginner. By the end of this video you'll know how to pick the right platform, set up the right accounts, avoid the mistakes that trip up almost everyone, and build a simple portfolio that can grow for decades without you having to babysit it. Quick disclaimer before we start, I'm not a financial advisor and none of this is financial advice. This is simply what I would personally do if I were starting from zero today. Most people never even get past step 1, and honestly I understand why. There are more investing apps in 2026 than ever before, half of them promising instant riches, robo-advisors managing your money with AI, and endless ads telling you which app is the best. If you're a total beginner, it's overwhelming and it's easy to freeze before you've even opened an account. So here's my checklist, the exact things I'd look for in a platform if I were starting today. First, it needs to be properly regulated and protected. If your country has a deposit or investor protection scheme, make sure the platform is covered by it. If it isn't, I'm not interested, full stop. Second, I look at the fees. In 2026 there's no excuse for high fees. Competition has pushed most good platforms toward low cost or even free trading. Even a tiny percentage in fees compounds into thousands of dollars lost over a few decades. Third, it needs to offer the right account types, especially a tax-advantaged investing account, and a solid range of stocks, ETFs, and index funds to actually build a proper portfolio. And finally, it needs to be simple to use. The last thing a beginner needs in 2026 is an app so cluttered with features, alerts, and crypto pop-ups that investing feels like a video game instead of a long-term plan. There are several solid platforms out there that tick these boxes, so do a bit of research. Compare 2 or 3, and pick the one that feels right for you and your country. The platform matters far less than what you actually do once you're inside it, so let's move on. Before you open an account, get a few things ready. You'll need a valid photo ID, like a passport or driving license. You'll need your tax identification number, whatever that's called where you live. You'll need proof of address, a recent utility bill or bank statement will usually do. And you'll need to be ready for a quick identity verification selfies. So find somewhere with decent lighting. Now here's where most beginners quietly cost themselves thousands of dollars without even realizing it. And that's picking the wrong type of account. When you open an investing account in 2026, you'll usually be given a few options. The first is a standard investment account. It's just a normal brokerage account where you buy and sell assets. You can open as many of these as you like across different platforms. It's a bit like having several bank accounts. But here's the catch. In a standard account, your profits get taxed. Depending on where you live, that's usually somewhere between 10 and 20% of whatever you make. The second option is usually some kind of leveraged or CFD-style trading account, built for short-term tradings. I'd avoid this completely as a beginner. The vast majority of short-term traders lose money, and it takes constant attention that most people simply don't have time for. The third option, and the one I'd choose immediately, is a tax-advantaged investing account. In the UK that's a stocks and shares ISA, in the US it's something like a Roth IRA, and most countries have their own version of it. These accounts let you invest in stocks, ETFs, and funds without paying tax on your gains. There's usually a yearly contribution limit, but that limit only applies to how much you can put in each year, not to how large your account can eventually grow. So you could build a portfolio worth hundreds of thousands or even millions, and still pay zero tax on the profits. If you only remember one thing from this video, remember this: always check for the tax-advantaged option first. The last option is usually a cash savings account with a tax break attached. Your money isn't invested, it just earns interest. It feels safe, but historically, interest on cash has been far lower than what a simple stock index fund has returned over any 10-year stretch. Cash has its place for emergencies, but it's not how you build long-term wealth. Now let's talk about what to actually put your money into, because this is where most people either freeze completely or go the opposite way and gamble on whatever's trending online. Instead of trying to pick the next big winner, I'd build what's known as a 3-fund portfolio. It's the go-to method for a well-known community of long-term investors who follow the low-cost, keep-it-simple philosophy popularized decades ago by one of the founders of modern index investing. It's boring, it's simple, and that's exactly the point. A 3-fund portfolio has, unsurprisingly, 3 parts. The first is a domestic stock index fund, something that gives you a small slice of hundreds of the biggest companies in your home market, all in one purchase. The second is an international stock index fund, which covers companies outside your home country, so your portfolio isn't dependent on just one economy. The third is a bond fund, which is generally less volatile than stocks and helps smooth out the ride when markets get rocky. How you split your money between the three depends entirely on your age and risk tolerance. An older investor closer to retirement might go something like 35% domestic stocks, 25% international and 40% bonds. A middle-aged investor might choose 45% domestic, 30% international, and 25% bonds. A younger investor with a moderate risk appetite might go 55% domestic, 35% international, and 10% bonds. And a younger, more aggressive investor might skip bonds almost entirely, going 60% domestic and 40% international. Notice the pattern: the younger you are, the more risk you can usually afford, simply because you have more time to ride out a downturn. In my opinion, it's actually riskier to play it too safe while you're young, because inflation and lost growth quietly cost you more than a temporary market dip ever will. Once you know your split, actually placing the trades in 2026 is almost embarrassingly simple. Search for the fund or stock you want, choose whether to invest a fixed amount of money or a specific number of shares. Thanks to fractional investing, you don't need thousands of dollars to get started, and choose your order types. A market order buys or sells instantly at whatever the current price is. A limit order lets you set the maximum price you're willing to pay, so the trade only goes through if the asset drops to that level. A stop order triggers a market buy once a stock reaches a certain price, and a stop limit order does the same thing but places a limit order instead. As a long-term investor, I'd mostly stick to simple market orders. Small price differences barely matter when you're holding something for 20 or 30 years. Most people obsess over when to buy, but knowing when to sell matters just as much, arguably more. Here are the three main situations when I'd actually consider selling. The first is when momentum, not fundamentals, is driving the price. Some assets rise purely because of hype, social media chatter, or short-term trading crowds, not because the underlying business is actually worth more. When a stock is clearly running on hype rather than real numbers, I'd consider trimming a portion of it, maybe 30 to 40%, to lock in some profit before that momentum inevitably fades. The second is when I need the capital for a genuinely better opportunity, a property deal, starting a business, or some other use of money that clearly outperforms just leaving it invested. Sometimes the smartest move isn't holding forever, it's redirecting money towards something with more potential. And the third is when the fundamentals themselves have changed for the worse. The company is losing ground to competitors, management is making reckless decisions, or the entire industry is becoming obsolete. Stocks don't care how loyal you are to them. If the reasons you bought have genuinely disappeared, holding on out of habit will usually cost you more in the long run. At the end of the day, here's the truth about investing in 2026 that hasn't changed in decades. Time in the market still beats timing the market. Compounding doesn't care about hype, headlines, or how confident you feel on a given day. It only rewards consistency. The people who build real wealth aren't the ones chasing every new trend. They're the ones who keep investing steadily, reinvest what they earn, and simply give it enough time to work. So invest consistently. Reinvest your gains and be patient. That's the exact strategy that's made me millions, and it still works just as well today as it did 40 years ago.